It does feel that way, though, in equity markets. 8 straight days of gains. There's somewhat of a rally taking place right now. What do you think is happening?
Well, I think what is happening is that, what the markets are pricing in is slower growth. And the question is really whether the inflation is actually as high or not. So the markets are really questioning whether this narrative of transient inflation is actually right or not. So far, the bond markets are remaining calm. So, all these expectations of bond yields going to 2%, 3%, none of that has come to pass. Bond yields are very much stuck at 130-ish and do seem like they want to head towards that sort of 1% level, especially if it becomes clearer that inflation isn't coming through. Meanwhile, the central banks continue to pump liquidity. Every time they talk about wanting to remove that stimulus, you get a weaker jobs growth data, you get renewed virus cases, and they just seem to have to delay it even further. But that's going to be the big question, I think, going into the end of the year.
Well, if you look through the noise and all of this and the high-frequency data points, because the narrative changes almost from data point to data point, where do you think yields should be headed anyway?
My view is that something structural has actually changed in the economy that the economists haven't really got on top of. I'm not an economist, so I'm not smart enough to know about that. But something significant has changed, and the way that they set policy, especially if we look at a country like Korea, which has got sort of declining populations and sort of no inflation really, and they're raising rates. And even in Australia, you're looking at sort of COVID has stopped immigration happening, and if you get through this transient inflation, really are they taking a big risk by raising rate or sort of ending the support right now, or is it better to actually wait for a little bit longer? But I do think that something structural has shifted in the global economy that hasn't really been captured so well by the policymakers, although the markets do seem to be aware of that.
I want to go back to your earlier point and the inflation story, because when you look at supply chain bottlenecks, for example, you look at shipping costs, container costs, there seems to be some inflation that's clearly in the pipeline that might get passed on to consumers. Is that being priced properly by markets?
I think the bond market is actually one of the smartest markets that I look at. And often, even if you look at when the bond yield started going lower, nobody could really understand why it was happening. People were saying, oh, it's technical positioning and whatever. But I actually think that there is something else that is going on in terms of the longer term inflation story. Now, it is true that there are short-term bottlenecks, and we can see that. We're actually expecting inflation to drop off over the next couple of months, and then at the end of the year, maybe sort of start looking a little bit firmer again. But certainly, it doesn't seem at this moment that there's enough pressure out there for a whole-scale reevaluation of inflationary expectations.
4 months till the end of the year. Are conditions still conducive to risk assets? Let's put it that way.
Absolutely. At the moment, we think markets are a little bit short-term overbought, but we think that there'll be a dip, maybe about 3%, taking the S&P down to around 4,400. Some of the conditions are looking a little bit complacent in equity markets. But remember, even if the Fed announces a taper, which I don't think it's going to happen at the September meeting, maybe at the November meeting, but even if they announce that, remember that there's still over $350 billion of liquidity being provided every single month.
Right.
So it's sort of, the trajectory may flatten a little bit, but there's still a lot of money that is being provided. If you go back to 2009 and you said, they're going to provide $350 billion of liquidity, that was the equivalent of a QE1 program every 4 months. That's the scale of money that we're still talking about. So, it's going to get trickier, I think, in 2022. But at the moment, our projection for the S&P by the end of the year, fair value is 47.65. That's on the trading side.
Yep.
And that's very much higher than the fundamental value, fair value, which our strategists think is around 4,000.